Welcome back, everyone, to Vox Markets Live. My name is Paul Hill, and I'm delighted again to be able to speak to equity analyst and stock markets commentator Paul Scott from sunny Gozo again. So, big welcome, Paul.
Thanks, Paul. Hello, everyone. Greetings from Gozo. And has it been by popular demand this time, Paul, or not?
Well, yes, definitely by popular demand. In fact, we've had a ton of corporate news, surprisingly, actually.
Yes.
But I think it's a bit of a sort of just a consequence of the confessional period for a lot of businesses heading into their results. They come out with sort of like trading results up or down. The US earnings season kicks off next week, so it's not surprising, I suppose. But before we run through some particular stocks, have you been buying or selling anything over the past week?
A few minor transactions, yeah, just top slicing one or two things purely to raise cash. And I've added to my two of my core long-term positions, both of which have slightly wobbled lately, Spectra Systems and Beeks Financial Cloud. So
Okay.
I leave it 2 or 3 days until the announcement. I like to sleep on it, digest it. You know, I don't think you don't want to be doing impulse buying, emotionally driven. You want to give it a few days to calm and collected. And so, but I'm more than happy to top up those positions. So yeah, you done anything, Paul?
Yeah, well, we'll come on to Beeks. Definitely, it's high on the list on the questions. Yeah, I've actually just sold, not just, but I sold my Treatt on Monday before today's, before the trades update. And the logic was such that Dola took, which is a rival to the competing bid from Natara. They've got about a 10% stake, which is bought at £2.85. Natara increased their bid to £2.90. And I was sort of thinking about how likely is it that this deal's going to go ahead. Now, nobody knows, but I suspected at that time the reason why Natara didn't put a 3 on the figure was because they've been given proprietary access to how the business is trading, and they've pushed it up to their final offer of £2.90. So it didn't surprise me one bit that they came out with a week trading update this morning, not saying that they were out of line with the FY25 September FY25 numbers, but it did. It was lining it up for a profit warning for next year. And so on Monday, I sort of like presumed that they'd been given proprietary access to it. Hence, the £2.90 was going to be their final offer. And I actually think Dola, I could be wrong, but I don't think they're interested in buying. I think they're interested in sort of like blocking the stake. So I think, having bought it at £2.85, I got a sneak suspicion they're going to vote against it. Now, given they've got 10%, they can't vote to actually stop it going ahead if it gets the 75% on the scheme of arrangement. But if any other fund managers also feel as though it's a cheap bid, or opportunistic at £2.90 still, given that they've got a weak trading outlook for next year, if they still think it's that, then I think there's probably a 50% chance that this could get voted down at £2.90. And on that basis, I actually think there's probably a 50% share price move either way. If somebody comes on, it could easily go at $3.30. But it could easily go down to where it was before, sort of like. And I think I'll just put the chart up, and it was trading at round about. This was before interest. It was less than £2, £1.90. It was trading at. So it could go down. It could go down to £2.20. But anyway, that's what I did. So I sold my Treatt, and the reason why I sold it because I wanted to remain in food ingredients, and we talked about it last week, and I went into Tate Lyle. Okay.
Oh, did you? Yeah.
Now Treatt is currently trading at about just under 11 times EBITDA. Okay, which is about what you'd expect for a more commoditized food ingredients business. Now, Tate is trading at less than 7 times EBITDA, and I actually think it's a better quality company because the profit margins are better. It's got more cyclical growth, and it's actually got, to be able to put it, it's actually got a really good sweet spot in its sucralose sort of like stevia business, growing really strongly, nice margin, 30% EBITDA margins. And it's going to offload its final bit of commodity stuff over the next year. Debt is what we talked about was the problem at about 2.2 times EBITDA. But I think the long-term fundamentals of this business are fine. And interestingly, something we didn't discuss last week, a year ago, when it hit £8, Advert International, the private equity house, was sniffing around it and was being sort of as a potential, another private equity buyer. So I've got a sneaky suspicion. I could see private equity looking at this again. It's currently on 7 times EBITDA. If it went for 11 times EBITDA, which is about where Treatt's going to go out, if it goes out at that at all, then you've probably got at least sort of like 50% upside from here. So I think £6 could easily be achievable if equity starts sniffing around again. But anyway, I've done it for the long term. So that was why I sold Treatt before today's trading update. I sold it on Monday and then bought Tate. And there has been a flush out because one of the shareholders, Columbia Threadneedle, has just got rid of 5% over a couple of days ago.
What, 5% of Tate and Lyle?
Yes.
Right. Okay, that's quite interesting. And I'm sure I know the answer to this. Just to clarify, when you're talking about 7 times EBITDA, you're doing enterprise value over EBITDA, aren't you?
Yes, I am. That's right.
So you factored in the debt. Yeah.
You factored in all the debt. Yeah.
Yeah, that's interesting. The only thing I'd slightly push back on that is I think if the Treatt bid falls through, I would see it maybe settling at £2.50, £2.60 level. So I don't see a huge percentage downside, and then you'd get longer term upside, because I mean, management clearly said to us when we spoke to them not long ago at Treatt that this was just a bump in the road, that they had a very strong pipeline and all the rest of it. So I just see it as a bit of a pity that the upside is being whipped away from the existing shareholders right at the sort of low point. But how
did you come to your 250?
Oh, just guessed.
Okay, right. Okay. Well, when I guess, I try and put a bit of science onto it. So £2.50 would be roughly around about 9 times EBITDA. Yeah. And that's
but it's bottom of the cycle earnings, isn't it? I don't think you value it on what the current year numbers are.
Well, it was valued at the same level multiple of about 6 times, like Tate, at about £2 before that. So I would not be surprised if it went back, because Dola is going to, if the swing factor is what Dola want to do, because if they decide to actually fill their boots and decide to have a competing bid, and they could definitely do that. Yes. They could turn, because they're allowed to, because there's an increased bid. But if they decide to have a blocking bid, then they're going to block any other interest going forward as well. I think if it doesn't happen, it will be below 250. I think there's at least 50p upside and downside on this, depending. Okay. Did you speak to Lord Lee at all, by the way? Because he's
no, I missed his call. He rang me yesterday. He wants to talk to me about Treatt. So yeah, I'll give him a shout. Have you done? Have you?
No, I haven't got his phone number, but he does. I'm not on his bat phone.
Riffraff like you don't get onto the Lord of the Realms phone book.
Exactly. Anyway, we've had a ton of questions beforehand about. Well, I'll give one of them from John. He's asking about Beeks Financial, which is one you've just topped up on. There's a surprise, because obviously it's really been the main corporate news of the week. This one, just for everybody's understanding, does tech infrastructure and a bit of software for high frequency traders, and it's been selling it to hedge funds forever, but now has started to go further up in the food chain to the exchanges, and inked a deal with NASDAQ that seems to have reversed. But do you want to take us through their results, which they pushed out this week?
Yeah, I mean, one of my readers complained today that I'm talking far too much about this, but I think it's a very interesting company, so I'm going to talk about it. It's very rapid compound growth. So it's all about the growth, 20 to 30% compound growth. It's done every year since listing in 2017. The growth is accelerating now. They've got a huge opportunity. They're becoming the kind of standard cloud-based specialized niche service for exchanges, which you're not just talking about stock exchanges, you're talking about forex markets, bond markets, crypto. Of course, there are a lot of big crypto exchanges. It's a deal with a smaller one. So this is an accelerating growth story, and that's what interests me. The valuation is high. There's no getting away from that. People can slice and dice the accounts in different ways. I go for the more conservative figures, the statutory numbers. Some people use the adjusted numbers. But because it's a really almost unique, I think, on the UK markets, compound growth story that's really becoming the kind of gold standard for exchanges all over the world. We, the company wasn't able to talk about who the particular client was that they lost, but we've worked out who it is. But I'm not going to say because I don't want to cause embarrassment or whatever.
I'll say it's NASDAQ.
Well, I couldn't comment because the thing is I'm interviewing the company in about an hour and a half, so I don't want to ruffle feathers. So yeah, basically there are special it was all explained on a webinar yesterday. He went through it and said, look, there are special facts that work here, which you don't need me to repeat. People can just listen to the webinar. Basically, it's expensive it's expensive now for value investors. It's not of interest, but for growth company investors, I think it's pretty much unique. So I think it's really interesting.
Why did they lose the contract?
It was basically they were getting too close to the backyard for the hyperscalers, who seemingly put pressure on the client to kind of not actively promote this product. Yeah. So it just fizzled out because the client just was pressurized politically, if you like, into not promoting it. The good thing is we've not seen that ever before in any other client. It's the absolute opposite, for example, in Johannesburg. And I've been saying for a couple of years now, the excitement is not getting the absolute top level exchanges because everyone who needs to connect to them already is, basically. It's the next tier down, the regional stock markets, where there's a huge opportunity for Beeks. And Johannesburg have now upgraded the contract 4 times. And the CEO was just raving about it yesterday. I've never heard him so bullish, basically. And they've got four more. Yeah, but he tells it like it is. You know, yeah. I followed this since it listed 8 years ago. You can really tell a lot from the tone, the demeanor of the directors, I think, and they're super confident about where this is going. They've got 4 more major exchanges. Stock exchanges, I assume, but it may not necessarily be stock exchanges, in the final stages, they said. So, you know, you're going to get lovely news flow over the next year of more contract wins. It's all building and building annualized contracted recurring revenues, whereas it used to just be monthly repeating revenues. They're now getting 5-year contracts. They said basically a 5-year contract will be a 15 to 25-year contract in reality. Super sticky. Apart from obviously the one-off contract that never got off the ground, and they've achieved their numbers even without the sort of gold, you know, the big contract. So I think I totally understand why some people don't want to pay up for the growth, but I think for a tuck away and forget share, I think this has got so much potential. In my personal opinion, could be wrong.
What value do you put on it? What's your fair value on it? It's £2.20, isn't it? 2.17.
Yeah, I mean, I think PE is not suitable for high growth companies. So PE goes out the window for me personally. I mean, EV to EBITDA obviously is a popular measure at the moment, isn't it? If it's 13 million EBITDA, so it's on whatever that works out about. It's not excessive. It's what, 10 or 11 times, 12 times, which is not excessive at all for a very rapid growth recurring revenues business. So but the trouble is the EBITDA, you know, they capitalize R&D. They have a couple of million of share-based payments every year that are basically staff bonuses. So you can chip away at the EBITDA quite a lot, which I fully appreciate. And I actually do in my figures, but you bolt on 4 or 5 years of compound growth at the rate that I think, if anything, might even accelerate. You've got a business that could be worth, you know, considerably more. Yeah. And as he said yesterday, the CEO said yesterday, you know, we're now at a point where we've got 4 or 5 really major, you know, big regional stock exchanges using us without a hitch, no problems whatsoever. He said well, exchanges. He didn't say stock exchange. Exchanges, he said, are now coming to us saying, you know, look, this stuff works. We know, you know, our colleagues at Johannesburg or whatever swear by it, blah, blah, blah. So, you know, super confident yesterday, I think, in the webinar. So I'm looking forward to speaking to him myself and seeing if I can get any more color on these things in an hour or two.
Yeah. No, I mean, I think you're right in terms of, you know, which metric you're using for your valuation, EBITDA. Yeah. I think 11. You know, I'm agree. I think it's about priced correctly at the moment. The other way I would think about valuing it would be say, I think 90% of the business is infrastructure, tech infrastructure, and you're effectively putting it into clients' property, and so you're renting it out. Now, if you look at the ROCE on that rental on the rental business of 15 years or 5 years, however long the contracts are, it's about just over 15, 16. But it's much higher growth. So I would say that's probably worth 2 to 3 times asset base, in terms of what it's actually. And then if you add on, say, 3 times for the software side, like 3 times sales for the software, you get to about £2. So I think either way you look at it, whether it's a pure asset, it's priced about right, but it actually at 10 times, 11 times EBITDA, it's not pricing in electric growth. And if it does deliver that, you can really see how it's going to motor.
Yeah, I think that's a very fair assessment. I agree with that. And I'm not saying I think it's undervalued right now. I'm saying it's the growth that I'm really excited about, because you don't often come across companies with this level of compound growth where you can actually see it going through the roof over the next few years. So that's the excitement of it, I think.
Good.
Yeah.
Good. Okay, on the same subject of software, we've got Claire. She's asking about Intercede, which is an expert software company for all things identification and cybersecurity. Sells to Zoo, fantastic client list out in the States. Came out with a slightly softer trading update this morning, which is probably not a surprise, because selling to federal customers when they're shut down at the moment,
exactly,
then it's going to be difficult to have a conversation with them when they're at home furloughed. Anyway, what was your take on it?
Well, I like this. I've got a small position in it. I've held Intercede for years, and it's done very well for me. I think it's priced about right. Yeah. I did a review of it pre-8 a.m. for my Substack. What we try and do is get a snapshot of what's all the company's news for everything apart from resources stocks out at 10 to 8. So people just bullet point one-liners. With Intercede, I said, okay, this update is a bit wobbly for H1, revenue down 4%, but they're saying in line for the full year. So they've got to pedal a bit faster in H2 to get to the full year. But they gave a long list of contract wins, very well managed, I think Intercede is. On about 30 times earnings, which I think is about right. Again, I think high quality recurring revenues business. You can't expect these things to just go up in a straight line. So, and it's got a lovely balance sheet. About 15% of the market cap is net cash, genuine net cash. So I like it, but I think probably priced about right. It dropped 10% today, which I think again is a rational move from the market. Just saying, okay, bit soft. We're not, but full year they reckon they can meet the full year. I think it's something like 44% they've done in H1. I do think they need to accelerate the growth rate though at Intercede if the shares want to do another big leg up. And they are from a low base. They're shifting towards SaaS, which I think is a good idea. But we need to see more of that. So I think this one, again, a bit like Beeks, is something I would probably park for 5 years. And I think you'll probably do very well. But it's not as exciting a growth story as Beeks. Of the two, I think the growth is much, much stronger at Beeks. But I like Intercede as well. So what do you think, Paul? I know you're better at software than me.
Yeah, I like the company, and it's a real sort of like best in class point solution because it's got best in class customers. There's no doubt about it. The only thing, if I was a shareholder now, I'd be watching closely how long this government shutdown is going to last. Now, let's just assume, okay, it lasts what the market reckons, which is going to be towards the back end of this month in October, and Trump gets his way. He's going to sack a shed load of federal employees. If that's the case, then these guys sell their software on a per seat basis, on a per license basis.
Yeah.
So you might find actually if they've got a big exposure to federal customers, 25% of their, I don't know, that'd be the one thing I would ask the management team and watch. If the federal government decides to sack a shed load of people, then you might find actually their ID seat basis decreases, even though the customer still takes it, but it doesn't need as many licenses. And when it comes to discretionary spend, if there's anything discretionary, given they've gotten the shutdown, you might find that's less, sort of like likely to happen. That'd be my only take on it.
I mean, the only thing I'd say on that is, their annual renewals, I think the federal ones, and I'm not sure that if they adjust the level of seats down, and also, the company Intercede have always stressed this is mission critical. this is not discretionary spend.
Yeah.
Although I suppose new contracts, and it'll be part of a big, they sell through systems integrators as a small part of an IT package. So I suppose if for new clients, if the whole package just gets put on the back burner, that might affect Intercede. But like you say, none of this is a surprise. And obviously they mentioned Forex headwinds as well. Well, that's pretty, it's blindingly obvious. A company that invoices in dollars is going to, so nobody should have been surprised by today's update, I think.
Yeah, no, good. Agreed. Okay, Riken is asking about Unite Group, which is basically the purpose-built student accommodation landlord in the UK. Came out with a inline trading update for the end of September, but was absolutely, I think it also said that its occupancy level was less than that, heading into the new year was less than expectations, and its rental growth was less. Anyway, the shares took a bath, and they're still taking a bath.
They did, didn't they? Yeah, we don't understand this. Me and my colleague John, we looked at this update yesterday 2 or 3 times, and it read okay to us. But having said that, we're not specialists and we don't know the company that well. So clearly the market reaction is adverse. But I have to say, for value hunters, the numbers are looking really attractive on this. It's obviously, as you say, the student accommodation thing, quite substantial, 3 billion market cap. You're looking now at a 6% yield. You're looking at a substantial discount to NAV as well, I think. So we think it looks interesting. Have you looked into it, Paul?
Yeah, I have. Net tangible assets I've got is about 980, so it's about sort of 35% discount to net tangible book. The thing I'm worried about here, okay, is not if you read the announcement, it wasn't the demand from the students. The students were still coming in from the UK, and it had stabilized from China and from the international. And it also wasn't so much, they were still doing rental growth. It just wasn't as high as they originally thought. The big thing the dial mover for them was extra. There's too much capacity in student accommodation at the universities, which means that they're doing better than everybody else, but their occupancy and their pricing is softening off, and that means if you're at the bottom of the tree, you're really going to suffer. It's just too much supply, or too much supply, and so, I mean, I would say it wouldn't be I think you could. Who knows? But it wouldn't be. I think there's better REITs in this area than United.
Interesting. And of course, we noticed as well the price of Empiric student property dropped in sympathy, which they're in the process of taking over, aren't they? Yeah. And I think you're right. If so many student places have been built, haven't they? Watkin Jones specialised in that area as well. A huge amount of capacity added, as you say, and. If you got oversupply, then the capital values could be overstated, couldn't they? I mean, I always work on the basis that EPRA NAV values that these REITs put on themselves probably 10-15% overvalued. But it's dropped an awful lot this year, hasn't it? It's definitely worth a deeper dive, I think, this one.
Yeah, I would be cautious if there's too much supply. Then that's an industry problem. That doesn't say, if you're a landlord, that's not great. But anyway.
True. But the other interesting thing is, of course, Paul, there's nothing, I would imagine, nothing limits these to letting them to students. You could have young professionals renting the individual studios. There could be a much broader market for it potentially. I don't know.
The problem with that is that they tend to let to the students on a termly basis. You do 3 terms, and then they rent. Right. Then they do them for conferences in between.
True. Yeah. So, I mean, maybe you could have a wing in a building, that could be repurposed for young professionals or something like that. So
Okay, good. We got Paul the Parrot. He's asking about another REIT, similar area, Grainger, but at least they don't do student accommodation. They do. Build to rent types of new property that goes out to young professionals in the major cities. Seems to be going very well, actually. Came out with another strong trading update. Shares similarly though are trading at about 2/3 of net tangible book.
We've talked about this a lot. You own some, I think, don't you, Paul?
I do. I like it.
I like it too. I had a quick look at it this morning, the update. I can't find my notes here, so I'll have to just do it from memory. It was, no great shakes. I think it was in line, wasn't it? Basically, yeah, it's just a much easier way of owning residential property than actually buying a buy-to-let. You get it at a third discount for a start. Here we are, 98% occupancy. Like-for-like rental growth, 3.6%. No clear outlook or guidance, though. We thought that was a bit naff. They could sharpen up and actually give us a bit more information. You've got you've got a loan to value of 38.5%, which is fine. Not a little bit on the well, no, it's all right. I think 30 to 40 is the normal range, isn't it, on loan to value? And 4.5% yield is not great for REITs. You can get much higher yields, but you're getting long-term growth, and you've got good downside protection with Grainger. I like it too. I think it's good.
Yeah. Anyway, good. Okay, let's move on. We've got Claire asking about B&M, in the retailer. There used to be a bit of a treasure hunt type retailer, but I think the shares now are almost all-time lows because they came out with another softer trading update. I know we've liked it on value metrics, but is this now a value trap?
Ooh, good question. I don't know. I mean, I think we were quite surprised that me and my team were quite surprised. Here we are, Tuesday. It warned on profit again. I don't know if it's the third or the fourth. I can't remember, but it's a very distinct pattern. Anyway, new CEO has been in there 4 months. I don't know anything about him, but I'm hearing good things about this new CEO. Apparently, he's a value retail old hand in the sector. The question I think everyone's asking is, has he kitchen sinked it? Is this a new CEO just saying, right, let's set the bar nice and low, then I can come out and say I've improved this, this, and this. He's basically saying it's a 12 to 18 month turnaround, that there are operational problems, that they've taken their eye off the ball on the basics, if you like. We've decided to stay positive on it because we think this should be relatively straightforward to sharpen up on the buying, on the margins, the operational stuff. Its stock availability, I think, has been an issue. So really just basic retail things have not been going right. So we're staying moderately positive on it. We see this as a bump in the road. We don't like the balance sheet. It's got too much debt. And that does put a little bit of a question mark over the 6% yield. I don't like high yields with high debt, because you can find management just say, actually, we're scrapping the dividend, to conserve cash. So that would be my main worry on this. And obviously, it's a very big operation. It's a huge business. So how long will it take to turn it round? I haven't bought any yet. I've been ever so close to buying some, almost all the way down on that chart you've put up there. But I would have wanted it, say, a 20% dip on the profit warning. It only dipped 7%. I don't think that's enough. And I've noticed a lot of the premium brokers in the last couple of days have put through some swinging, deep cuts on the target price. And that normally weighs heavily, because we mentioned last week, there seem to be algorithms in the market, don't there, betting heavily in the direction of broker upgrades and downgrades. So what's your take, Paul?
I think they're losing market share. Now, that may well be just because they're, poor execution and these back to basics type of, looking at product and pricing of particular items. Yeah. I think what it is actually the whole game of having a little warehouse that you go in there and have a treasure hunt and go in with one thing and come out, idea to come in and you come back with has actually lost its sheen. And I've got a sneak suspicion, no pun intended. And, basically, Timu or something like that is just absolutely nailing it, because it's an old format, and unless he can really energize consumers to come into store and really enjoy it as an hour that they can have a great fun, pick up some bargains and really feel delighted, unless he can change that attitude and the experience for consumers, I think they're in for a hiding, actually.
Interesting. Yeah. Funnily enough, the other day I was just daydreaming about retailing, as you do. And I thought to myself, do you know what? If Temu opened a huge shed in Britain and actually started directly retailing, it would be an absolute frenzy. Those Black Friday videos you see in America of people literally fighting over things? It would be like that. And I think the Chinese are coming for us in terms of actually doing direct retailing in the UK. That is the next logical step. They don't need the retailers as intermediaries, So I think I've just talked myself out of buying B&M stores.
No, I mean, it's work. if he turns it round and gets the excitement back in, I'd be interested to have a look at it. But I unless he does that, I think it's a value trap. But it could change. Who knows? It could change.
It's still profitable though. It's still generating a lot of cash.
I've done that before. I was like, there's plenty of business that just that E keeps declining. It's like a melting ice. Particularly,
I've been caught so many times on value shares on the same thing. Yeah.
Particularly when costs keep going up, with NI and wages and all that kind of stuff. Okay, let's go for IPOs. It's opened for the market. Brian, he's asking about Beauty Tech, the new one this week, 300 million market cap. It does all things sort of like helping ladies' skincare and sort of like toning and anti-aging. They're sort of like technology. I think I've seen they put this mask on your face for I think it's mainly for ladies, well, maybe for blokes as well. I don't know. I don't want to be sexist. And it does ultraviolet LED lights and I don't know, ultrasound, and smooths out all the wrinkles and makes you look beautiful. It's got a couple of good endorsers. It's got Kim Kardashian. And I think Serena Williams also does it. Sells through high-end retailers like Harrods and stuff. Anyway, the value, he got away pretty much well on the IPO. What was your first sort of view from it at all?
Well, I was just in the village square having a chicken Caesar salad, and I thought I'd better do some research. I had the laptop with me. This was an hour ago. So I looked up its investor relations page, and apparently it's 90% online business that they do. It's founder-led, and at that point, it detected that I was in Malta and wouldn't let me download the admission document. So I'm afraid, thanks to the limitations of my current domain, I couldn't actually do anything out about it. So I'll have to come back to you on that one, Paul. Okay. But isn't it great? Isn't it great to see an IPO of a reasonable size that's not? Is it profitable? I'm assuming it is profitable.
Yeah, I mean, I've done some of the. I did manage to download the IPO document, Brian. So just to give you an indication, it does 18. For my numbers, it does about 18% EBIT margins. It's growing. It's growing at roughly around about 10-15% organic. Obviously, it's looking for further growth, sort of like internationally. It trades at roughly around about 18 times PE. So it's not cheap, but for a high growth niche type business, it's not bad. And I think it makes 60% gross margin. So that the EBIT margins can significantly scale if they sell obviously more of this equipment. I don't know what the big sort of like area that I would concentrate on is competition in this area, because is there other technologies, is there other skin creams and blah blah blah. I think the big benefit you get is that this technology is already used extensively in beauty salons. Not that you and I go to a beauty salon very often, look at it the way we are, but me anyway. But anyway, if you go to a beauty salon, you can get this treatment, you can buy it, and the big USP of theirs is that you get the beauty salon equivalent technology at home that you can then use on yourself in your private private area. So I think that's why it's convenient, it's cheap, and you haven't got to spend all your time going down. But some people like going down to beauty salon, I suppose. But anyway, that would be my take.
Yeah, interesting. And I suppose we'd want to find out what the IP protection is on the processes and the products. I just wrongly assumed it was something to do with makeup. So I think I misled people accidentally on my podcast the other day. And also the other key thing for me with IPOs is what's the purpose of the IPO? If you have a lot of vendor selling, and it's basically to let a venture capitalist cash out or private equity cash out, I'm not really interested. But if it's to raise money for expansion and you've got a bit of vendor selling as well, that I think is a good reason for an IPO, isn't it? So I'll try and have a look at it if I can get through the international IP barriers for next time.
I think they raised, just a member of the IPO, just top level, I think they raised about 110 million or something like that. 100 million. It was quite a big chunk, of which about 70% of that was the conversion of the debt or preference shares into equity, and they sold the equity on that conversion to wipe the debt out. And then they raised another 30 to 40 mil of money for the company. So they start with a zero cash, zero debt balance, I think, on day
Okay,
one.
that sounds like a private equity exit type of deal, doesn't it?
Yeah.
Things like preference shares is often private equity. Yeah, quite interesting.
I think it was actually quite a few VCs, venture capital trusts, because I know I think Mercia Asset Management were one of the early VC backers, so they've made a good number on it. I think not themselves, but through their funds.
Yeah, Mercy is quite interesting. We follow that one. We think that's quite an interesting alternative fund manager. So no, we're actually as well. Cavendish and Peel Hunt both reported this week, and they both said, I think Cavendish in particular said it's got a promising pipeline of IPOs. And Peel Hunt focused more on, said they were doing a lot on M&A deals. So those are two brokers that actually I think the shares are looking quite encouraging.
Yeah, interesting.
We're green on both of them. We're positive on them. They're doing all right. Yeah.
We got Prince's canned fish coming out.
Oh yes, well that's quite big, isn't it? And Shawbrook, I think, as well.
Yeah, be interesting.
So maybe London's coming alive again. Who knows?
I know. Okay, we're going to pivot, go to another sector. We've got Stephen Carhill is asking about CVS Group, the vet practice business. Came out with trading update or results, I believe. UK, I think, was flat. Australia's going pretty well. They've seen good trading of late, I believe. Anyway, in the round, what was your quick take on it?
Yeah, good. I mean, it's had a great run from the lows, obviously, that were depressed by the CMA thing. I don't think the CMA thing is actually fully reported yet. So we think the rise you see on the screen there, we think that's actually justified. It's a good quality business. It's pivoted, as you say, to expanding more in Australia now because they obviously perceive the UK as more tricky. Because of the competitive investigations. No, we think it's good. And the balance sheet is not great, but the goodwill, the intangible assets on the balance sheet are real because, of course, they bought all these vet practices and they could resell them probably for more than they paid for them. So this is one case where I would actually leave the intangible assets in the balance sheet. Debt's a little bit high, but I think it came down a chunk from them disposing of their pet crematorium, didn't it? Came down 20, 30 million.
Yes, that's right.
We think it's good, but I wouldn't be a buyer at this price. I think, it's been a lovely trade for people. Probably priced about right, I would guess.
Yeah, it's about 50. You're right. It's about 15 times PE. Yeah, probably is about right. But
with a bit of debt on top, probably about right, I would say. It's been a nice trade.
Yeah, I wouldn't buy ahead of the CMA finalisation, which I think is in a week's time or 2 weeks. It's mid-October.
Oh, is it?
It's imminent. Yeah, so it could be a clearing event either way.
Yeah, well, the trouble is, I mean, I chose the wrong one, didn't I? I've been in Pets at Home, and you could basically flip that chart over through 180 degrees, and that would be the Pets at Home. But I think Pets at Home, funnily enough, is mainly a vet's business, and it's highly profitable. But it's very good value now, I think. But their retail side's in a mess. So there could be a recovery trade there for people to flip their money into. You never know.
Okay, good. We got Ben Sharman. He sent me before the actual podcast. He sent me a request on System1 and just general views on the market, on effectively the media agencies. He was talking just generally System1, Saatchi, and anybody else in that area. But I think there's Ubiquity, isn't there? And there's also
all three warned.
But let's do System1 because the shares have absolutely been hammered, haven't they, of late?
They have. I like this, actually. I hold some myself. I'm about 60% down on them, but I only put a couple of grand into it. So it was just neither here nor there, really. Tried to buy some more the other day, but the bid offer spread is nearly 20%. So, sorry, 10%. 20p I meant. So that is an impediment. Very good webinar with the management, which got into a bit of a bun fight with the shares commentator Maynard Payton. It was read out a very blunt statement, basically calling for the entire board to resign. And the chairman kind of just slightly lost his rag a bit, but then pulled it back. It's very entertaining. So I pulled up my popcorn and really enjoyed listening to that when I was wandering around Gozo. But it's very interesting as well for what System1 was saying about the industry. They said basically in August, it just hit a brick wall for marketing, advertising and PR. Absolutely brick wall. He said the clients just pulled the budgets on everything. And I think Ubiquity said something similar, and Saatchi's is normally impervious to these trends, but they've warned as well. I wouldn't be surprised if we get more Q4 profit warnings from this sector. But as System1 said, it could come surging back because it's mainly the uncertainty on tariffs. And the safe pharmaceutical companies, they don't know where the factories are going to be, let alone where they're going to advertise. So it's discretionary spend, and System1 said, look, advertising marketing, it is discretionary. It's the first thing to be pulled. So it was a good reminder that actually this sector's a bit of a can of worms. But you've got to anticipate the recovery. And I think maybe we're getting to that point where we should be maybe nibbling at some of these things to catch a trade, over the next year on a recovery, maybe. So that's my current thinking on it. I suspect you're probably going to say you just won't touch the sector at all.
Well, you're right. You've read my mind, absolutely. But if I was going to touch the sector, I would be quite discerning on which subsectors I would go for, and the ones which seem to be doing better than any of them. Okay, sports and entertainment. So you've got basically, when we were having a chat to John, and I can't remember his surname, or the new exec chairman of Mission Group, he was saying the sports business is actually doing really, really well. That was backed up actually by what Saatchi did this week, because they bought some women's sports.
They did, didn't they? Yes.
And in their previous announcement, they said sports was doing well. So that's a tick in the box. If you've got good exposure to do that, and the thing is with Saatchi as well, they've got excellent exposure to what they call the issues division, which looks after sort of like aid packages around the world to help in relief agencies and give them advice. That's doing nicely. The areas that are really weak and taking an absolute hammering in media are technology and pharmaceuticals and healthcare, and that's because of the US basically. So I would if I was going to choose between them, I would make sure I was more at the moment into sports, because I think System1 is more healthcare and tech. And I've got a sneaky suspicion the other two, Mission and I think Ubiquity is into tech and healthcare as well. So you just got to be very careful. You'd have to have a look at it on a very microscopic detail.
Yeah, I wasn't aware of that, but I'd look at it the other way. I'd say, well, let's be contrarian. Let's see what's been beaten up so badly that it's going to recover. Well, with System1, it's got 10 million, 11 million net cash. 25 million market cap. I wouldn't. Whereas TMG, as the Mission Group, has got the opposite problem with too much debt that they need to reduce. So the one I'd go for, because of the balance sheet, and is System1, and they said their pipeline is the strongest it's ever been, but it won't convert until the new financial year. So you've got that catalyst there. You've got the very low valuation, and you've got the cash pile to protect your downside. So that's why I'm actually thinking of topping up the System1, but I haven't done so far because I haven't got any spare cash.
Yeah. Good. Okay, brilliant. Okay, we got let's move sectors. We've got healthcare. We got Joe. He's asking about Inspiration Healthcare, which is basically a medical devices company that does neonatal ventilators, about 60% of its business. And I think the other third is roughly to do with a distribution business in the UK to do infusion pumps for people who struggle eating. They go through the mouth and stuff. And then the final bits and pieces, they've got this ventilation business in the States, which is used as their bridgehead for their new SLE they're trying to sell into the States next year. I don't know, they came out with results this week. No, was it results or was it trading? I think it was results, wasn't it?
Yeah, it was H1 results this Tuesday. We're a bit down on Inspiration Healthcare, I'm afraid. The reason being, it's not a bad business. Revenue was up 41%, but only break even at the operating profit level, boosted by 2 large contracts in H1. The problem in line for the full year, but then the broker reduced the forecasts by 15%. But it was only a small, because it's so close to break even, it was an insignificant amount of money, which looks bad in percentage terms. So we're not too bothered about that. The main issue for me is the balance sheet. It's got too much debt, 6.7 million debt for a business that doesn't really make any money. We think there are some positives. I don't want to sound too negative, but we think it might have to do a fundraise. So for that reason, we're going to keep clear of this until it strengthens its balance sheet, I think.
Yeah.
You're good on medical stuff, Paul. What do you think?
Well, I disclose I own the shares. Okay.
Sorry.
No problems at all. No, I mean, I've been underwater for a long time, so I've owned for about 2 years. I did actually speak to the CFO this morning and asked him specifically about the debt, etc. And they're totally clear of any banking problems. Like there's no waivers or there's no covenant breaches or anything like that. So they're absolutely fine. And the debt's coming down, because the reason why the debt is high is because they've got high inventory levels and they've got high debtors. Okay. But mainly on the inventory side, and they're going to see probably a reduction in net debt of about another 2 million by the end of the year.
That's fine then.
Yeah. Now, going forward, they've stripped out all of their large orders. They've de-risked those forecasts. Hence, you've seen EBITDA going from one level going down in the next year. But that's because there's no upside in there at all. And the turnaround, the big thing is to understand is the turnaround. The turnaround is happening. The CFO and the CEO are relatively new. They're hungry, and basically, it's another one back to basics. The one thing I do like about it is the gross margins are going up. They're roughly around about 45 to 50% gross margins. Now, once you get that scaling, you'll see that coming through the EBIT percentages up. And so you should get. There's no reason in the fullness of time that if this scales, the turnaround happens, it won't be sort of 15%, maybe even 20% plus EBIT margins, and very highly profitable is what it should be. The other thing which I do like, and which I'm being patient on it, is that the SLE ventilator technology is really well respected by the NHS and even more well respected internationally. And the big reason why they've slipped up is that, frankly, the sales and commercial teams before the new management team came in were taking orders rather than actually properly selling the product into their international distributors. Now that is changing, and it's a cultural change, which is obviously taking some time, but they're seeing more interest now internationally, and they had a big tick up from that. And they reckon they got the underlying growth is about 10 to 15% per annum from starting next year. So I think this is like if you've got which I have, if you've got a 2 to 3, 4, 5 year view, I think this could do really, really well. But as you rightly point out, it's not out the woods. If something went wrong, they wouldn't have too much wiggle room to start wiggling their debt. So it's not for widows and orphans. But I'm more pleased about what I heard this week about the turnaround than I have been for 18 months. So long may it last. But it's not for people who just want a quiet night.
No, I mean, I'm just looking at the P&L over a sort of 12-year plan, and it was actually a nice growth company up until January 2022, when the nice rising profitability trend just collapsed. So do we know what went wrong then in 2022 onwards?
Yeah, basically they had a large contract that was in the Middle East that they couldn't get signed over the line. And what happened? Those sales and the growth they'd anticipated, because there had been a lot of effectively stocking up going into the pandemic, as you remember, and during the pandemic, there was a shortage of absolutely everything. And so essentially everybody loaded up on stock, and then they had a normalization process, and it's taken a long time in the whole medical area to essentially run through that stock. So they had a slowdown in their sales. That contract, which they thought they could get rid of their, basically stock, didn't happen. It still hasn't fully happened. And so they got that credit crunch squeeze. And so consequently, not surprisingly, the shares have responded badly because the risk has gone up on the balance sheet risk. And then they did a little placing at about 14p, about I think it was mid last year, actually.
Yeah, okay. No, that all makes sense. And the other thing I would add to that is that I quite like turnaround situations where the business has previously been successful and had a decent margin, but run into some big problems. It adds credibility to it. I prefer that type of situation than something that's kind of always been jam tomorrow and never actually made any money. So I think this one, maybe I'll have a closer look at it. Yeah.
The management team are good. They're hungry. So I think that's as good. who knows whether they can actually turn this one round, but they are doing a good.
Yeah.
They're doing a good fist of it so far.
Right.
Okay. Okay, let's move on. We've got Drew. He's asking about AudioBoom. That was there some sort of chatter about potentially being bought out by somebody on Sky or something?
That's right. Sky News came out on a Friday and said, basically made it sound like it was it had bid approaches. But AudioBoom itself then put out an update after hours on Friday saying that it hadn't had bid approaches, but that it was conducting a wide-ranging review covering anything and everything. Basically, they put themselves up for sale. So the takeover panel, what do they call it? Formal sale process rules, I think, have kicked in, and who knows? Will somebody? They put themselves up for sale before a few years ago, and nothing came of it. So it's an interesting trade. I mean, we flagged this in January as something that could have legs, and it shot up, and then it came all the way back down again, and it shot up again. So it's a trader's share, very difficult to value. I just don't have a strong view either way on it. It could work out well, or I don't know. It's very difficult to value. But it has put out a series of good trading updates. But I just think a podcast intermediary is not really a very good business model. But the argument is that they're gaining traction on selling adverts and things. So I don't know. We just don't have a strong view on it, Paul. So how about you?
Yeah, I think it's very tough to value, because if I was trying to to assess what it's worth in the private markets, or somebody would be able to, I'd need to understand what synergies they could get out of it. And I haven't got that visibility. I'd need to do a lot of research before deciding whether this was under or overvalued. But it's clearly, it's clearly got a lot of view either way, hasn't it? There's a lot of people who love it, and then there's a few people who hate it. But I don't know. Paul?
Yeah, sorry, the internet just drops out for a second or two. So yeah, sorry about that.
That's no problem. Okay, let's go back to the retailers. We got Ramdens, the pawnbroker stroke retailer. The business seems to be absolutely flying in gold, but what's the not surprisingly, because the gold price is going through the moon. What's the rest of the business doing, and is the value here?
We like it. We think it's very good. We've been long-term bullish on this. Having said that, we did shift down from amber green to amber, which is moderately good to just neutral, purely on valuation grounds. It's the P has risen to about 11 or 12, and that tends to be the ceiling for both Ramsden's and formerly for H&T. These types of businesses just don't get valued higher than that. So we think you're right, it is getting a boost from the gold price. Again, who knows where that goes? I suppose if you're very bullish on gold, then you might see that that continuing for Ramsden's. I just think maybe it's getting close to the glass ceiling in valuation terms. So but if personally, I'd be banking my profits if I held, but I don't hold, so that doesn't really matter what I think. And the outlook was pretty good. So no, not saying nothing wrong with the figures. They were slightly ahead of expectations. So very good, but fully priced, we think, for this type of business.
No, I would agree. I also, I think wasn't H&T got bought out for about 12 times PE, and so this is 11. I mean, there's not actually that much upside in terms of multiples, anyway.
Yeah, I agree. That's exactly our view as well. Nice business. People have done very well on it. It may be time to consider top slicing or banking profits, but your money, your choice, as we always say.
Yeah, good. Okay, let's move sectors. We've got Pete. He's asking about rental company Speedy Hire. Did they ink a deal this week with HSS to basically take on some of their pro service equipment that will boost their, I think, sales or something? But anyway, the shares responded well.
They did. I'm not interested in either, I have to say, and it looked to me like a bailout deal. But the interesting thing in Speedy Hire's announcement is it reckons it was going to get a 2 to 3 year payback on the cash flow. I think it's investing 34 million, I think, in parts of HSS from what I could make of it. I've not looked at it in detail because I don't really rate either company, if I'm honest. And if I'm not, if I can't see myself ever buying a share, I don't want to spend much time and effort researching it, really. So, I mean, you've got a very good dividend yield on Speedy Hire, 7%. and it is strongly asset backed, but they've been very accident prone in the past. I'm not convinced it's well run. So not for me, but good luck to people with it.
It's amazingly cheap, isn't it? Sort of 6 times PE.
6 times? Are you sure about that?
Well, that's what I've got it to be. Yeah,
I've got 11 times. Maybe I did see the brokers raise the forecast quite a bit. On this announcement.
Well, anyway, I think it is cheap, but
cheap.
Yeah, I mean, it hasn't overachieved, has it, in the past in terms of it's definitely let investors down a few times.
Understatement of the year. Yeah, no, it has. It's just badly run. I never forgive them for losing all that scaffolding.
Yes. I did ask the previous CFO actually how they lost that scaffolding. And he said basically they did a full asset verification going into the pandemic, and then the auditors couldn't get around all the service go around for about 3 years properly. So they were doing rolling inventory, and then had to do a catch up one, and then realised, oh dear, it's 20 million of this is not reconciling. So that's how he explained it. But anyway, such is life. Okay, we got moving sectors. We've got Stephen Griffiths. He's asking about paper and packaging business Mondi that came out, was a bit of a shocker, I think, this week in terms of saw pricing and demand both going down and increasing costs. So you've had a triple whammy of bad news there, I think. What was your take?
That's exactly that's a nice summary, Paul. This is on Monday. It's quite big. It's a 4 or 5 billion market cap. It lost 700 million on the day in market cap. So I thought, let's have a look at that, see if it's a buying opportunity. Here we are. It dropped 17% by 9 o'clock on Monday morning. Do you know what the price is now, Paul?
Yeah, it's £8.70.
Oh, that's pretty much exactly as when I looked at it at 9 o'clock on Monday morning. No, as you're right, the more you read this update, a Q3 trading update, the more it deteriorated, really. They said trading's challenging. It's being squeezed on volumes and price. Well, that's your worst combination, isn't it? It's now forced into restructuring. Of course, restructuring usually people and facilities are cash costs. We think debt's too high. It's up to about 2.5 times EBITDA, but it does have good asset backing. I think it owns forests and things, doesn't it? It's vertically integrated. No, I think it's a can of worms, so not for me.
Do you know why the demand is going down? Which seems...
I don't. Just competitive pressures, I think. Oversupply. I think they mentioned oversupply, actually. Just industry oversupply. Yeah.
I suspect, actually, because I think they do quite a bit in the States, tariffs are actually making a bit of an issue on this, because previously it'd be imported. You know, remember that it used to be that you could have $800 worth of free product sent over. I do wonder whether that's impacted the usage of paper and packaging. I don't know, but if you're selling into the States and there's tariffs and there's now a big tax on small value items, then my suspicion is that more product is coming internally. It's staying in, it's coming from the US, and so you might find people can't afford to now buy something cheap in the States from China, because if they've got 100%, 20% tariff, they've got a small value tariff, then it makes it just uneconomic to do.
Yeah, it could be, isn't it? I mean, whenever companies blame macro and all the rest of it, it's basically someone else is eating their lunch, isn't it? People are getting the gear from somewhere. It's just not from this particular firm. So competitive pressures, no debt. No, I wouldn't want to get involved personally. And if you look at the chart, Paul, over the last 7 or 8 years, it's just been a long downward trend, hasn't it?
Yeah. Okay, good. We got Simon. He's asking about Secure Trust Bank, which came out with a bit of a dodgy trading update. I think down 17% just looking at it. I think these guys they're basically a lender to the motor trade, and I think they've just said they've decided to go out of the motor trade, and that's cost them more, and they're concentrating on corporate lending. But anyway, the shares didn't like it today.
No, this was a sharp profit warning today, which we flagged up at about 7:45. It's not one I follow. I mean, obviously, it's had a marvelous run after it oversold on the car financing compensation thing. But I don't know what people want to do. Do they want to bank their profits on it? Now, today it said it was going to miss, didn't it? But no, I haven't looked at it in detail, and I definitely wouldn't be getting involved. after that sort of run. But the balance sheet's still very strong, you know. It's not... it does look pretty sound. But do we know how the car finance thing ended up? Is it was going to court, wasn't it?
Well, I think the FCA announced yesterday that it was going to be about 11 billion for the whole industry, of which the city then took that as a positive. So they bid up likes of Lloyds. And then today, Lloyds came out with a trading update saying actually their 1.2 billion pound provision was going to be insufficient materially. Materially was going to be in too short, and therefore their shares have gone down again. So no, I haven't really got a clear signal. The market thought it was great news yesterday, but actually today they took a bit of a negative view when Lloyds came out and said they're going to have to open their pockets a bit further. And,
so maybe there are the two factors at play with STB today then. Yeah, maybe in sympathy with Lloyds and its own profit warning. Yeah, but this type of stuff, I just feel generally there's too much guesswork. Yeah, you know, I'd rather go with something that's simpler and where it's just clear cut that you're getting it cheap, you know, rather than having to do all this guesswork.
Okay, good. We've got Harry is asking about Gooch Housego, which is the photonics business. Did they come out with results this week? And I think the outlook was slightly weaker than they originally anticipated. What was your take on it anyway?
It's coming back to me. This is the one. It's going on my Hall of Shame because I've introduced a new Hall of Shame.
It's a very polite word. I thought it was going to be something a bit worse.
No, this is Tuesday. What I call the Hall of Shame, and I'm determined to stop this happening, is where companies could have put out a perky update and then the broker slashes the forecasts. And GHH did this. They said broadly in line. So, what's broadly in line? Maybe 1 or 2% down. The house broker then drops the forecast by 7%. Well, that's not broadly in line. That's a profit warning. So I'm really cross about this one. So I've dropped it from green to amber because it's just bad form doing this sort of thing. You know, just get the bad news out quickly. Oh, we're a bit behind. Sorry about that. We're going to be 7% down. Get it out there. The market can reprice it, and then we all move on. Instead, when they PR it and slip out broker downgrades and whilst telling us everything's fine, you just don't trust the management basically. And people could say, oh, they're badly advised, you know, their PR or their broker screwed up. No, the CEO and the CFO have to take responsibility for the communication. So I'm pretty brutal on this stuff, and it's because I spend all day every day picking through all these announcements, trying to find out where they're lying to us, you know.
So I mean, so overall, then you're sort of like neutral on the stock, are you? Was it?
Yeah, I think it's a nice business. Yeah. But it seemed that various divisions or the industry verticals, it was just giving mixed messages on, wasn't it? Some of them were good, some of them weren't so bad. So I don't know how that all fits together. I think it's on about 16 times or something, which is probably about right, I would say. But
I'm with you, to be perfectly honest. I'm not that comfortable with the gross margins of the business. It's only about 30% gross margins for something it just doesn't smell right as a high value, sort of like fiber. Yeah. I do understand though, they are got increasing exposure to defense and aerospace. So those are very good areas. And I think medicine, the medical side, the cosmetic surgery with lights, laser surgery is also coming back. But the industrial side is still pretty weak in the semiconductors, I think. But so it's sort of a mixed bag. Okay. We've got Ian. He's asking about Topps Tiles, which I think is doing quite well. I think in line with Wix and B&Q, and there's another one, isn't there? It's sort of DIY stuff. I think Topps Tiles is doing pretty well, actually.
Yeah, its last update we thought was really good, actually. You've got a smashing dividend yield with this, which we think is probably sustainable. That's nearly 7%. Balance sheet's okay-ish, nothing there really overall, but you don't need it when you're a retailer. Forward P is 12. I think did I imagine it, or did they increase the forecasts? I don't know if you've got anything on that, Paul.
Yeah, I think they
slightly up the forecast, didn't they?
Yeah, I think they did. They're doing. I think basically they've got double-digit like-for-like top-line growth, which is fabulous. But they've got higher costs. Or it's definitely beating the market, if I remember rightly.
Yeah, they're doing well. Record revenue, I think, wasn't it? Yes, yes. They are. They're doing. I think there's signs of life here. I think this could be a good one to. I'd like to pick some of these up for my personal portfolio, because I think it sounded a lot more confident than we've had over the last few years. So if it drifts back down again to 32, 33, 34p, I might see if I can squeeze some cash out of something else and buy a few. So I'm pretty positive on tops, actually. If you're patient, I don't think these things are going to shoot the lights out, are they? But as long as you get your 7% divvies, you can wait as long as you like, can't you?
Yeah. I think the DIY boys are doing quite well at the moment. I mean, there was some.
Kingfisher was very good, wasn't it?
Yep. Yes. And I think basically there was some news today about sort of talking about the consumer and houses, and there was some concern about, again, the affordability of houses in terms of, and that's why I think the house builders sold off. And so if you look at, as I said before, large, expensive, discretionary spend is not doing well at the moment, because I think consumers are just holding back ahead of the budget. Why get involved in a big capital project before basically what the landscape is on your taxes on the 22nd, which is stopping some sort of transactions. And then, but people are getting on with DIY because it's short, it's easy.
Yeah,
it's
makes
quick.
sense.
Yeah.
Yeah, that's one theory, isn't it? I mean, I don't think there's any evidence to confirm that for sure. I mean, the cars thing was okay. Vertu Motors recent update wasn't too bad. It was slightly down, profit slightly down, but they sounded quite perky about September trading. So I've not seen any. I don't know, and we're getting very mixed messages on the housing market, aren't we?
Yeah.
So I don't know is the answer. But going back to tops, I think it's not a bad one for people to consider. Yeah, I think it's looking quite good.
Just on Vertu, what was your view on that one? Because it came out with a big basically got hit, didn't it, by JLR, Jaguar Land Rover cybersecurity shutdown. It's about 5 million or something. We've seen this through the whole supply chain, both up and from the supplier side, and obviously going north. There was sort of like now into the retailers. This is quite a big knock, actually.
It is. It's a huge issue, this cybersecurity thing, isn't it? I mean, you think M&S lost 300 million? Co-op was practically shut down for a few weeks or months. I mean, it seems to be a massive existential threat to practically everybody. So I'm very worried about all this cybersecurity stuff. And with Vertu in particular, they announced, the market seemed to shrug it off though. They announced they've got 10 JLR dealerships, and they said they've taken a £5.5 million hit already, presumably on delayed sales and people standing around doing nothing because they can't get the parts to service somebody's Land Rover, I'm guessing. But they did interestingly say that they think it'll be covered by their business interruption insurance. And I think for that reason, which they said specifically does cover supply chain issues. So the market seemed to shrug that off for Vertu. The unusual thing with Vertu as well is it's fully tangible asset backed with freehold property. So you've got that kind of copper bottom base on the share, which even though I'm not bullish on its trading, and I don't know what's going to happen with all these Chinese EVs that are beginning to flood the UK. What effect will that have on Vertu's franchises? Is it going to eat up their market share? I don't know. Any ideas?
No, do the Chinese guys actually sell through dealerships, or is it?
I think so. Correct me if I'm wrong, but I remember Vertu saying they'd signed up one of the big Chinese, but I don't know. I'd have to do some more. Trouble is, I'm not really I don't think I'm going to buy shares in this at any price really. So I haven't researched it that thoroughly.
Yeah, okay. All right, we got Stuart. He's asking about Angling Direct, which seems to be doing pretty well, actually. Just a quickie on this one, because I think the gain like-for-like sales growth, even though it was obviously a very hot summer, so got plenty of anglers out, but the river levels would have been low. Maybe that means that the fish were biting. I don't know. But anyway, there's definitely there's life here in the UK. I think the overseas is a bit weak, but just a quick one on Anglia.
Yeah, we were very impressed. We thought these were good results. They seem to be doing all the right things, getting the margins up. It's starting to look like a proper business now, whereas in the past, I remember I went bullish on it at the beginning of 2023, I think it was, when it was at par with its own net cash pile. at about 20p. So you actually got the business in for free at that point in time, which frankly was probably a pretty accurate valuation of it. I don't think it was worth anything back then, but management have really done a good job, I think. They've improved the business a lot. They've got the margins up. They're doing all the right things, and I think it's now looking quite a nice business. Not convinced there's a huge amount of upside on it from now on. I think you've had a nice trade. But yeah, well done to Longs on this. I think it's definitely a viable business now. Is it a good thing or bad thing they're easing off on the European expansion? Good thing, in my opinion. Stick to your knitting, stick to your home market, I think. Focus on that. So yeah, it's turning into a nice little business, I think.
Yeah, I think your friend Lawrence Halls from Onward Opportunities owns it, doesn't he? He's done very well.
He's on fire at the moment. He's really doing. It's great. We need that. We need some small cap fund managers to start to. Well, He's delivered, knockout results now for 2.5 years, and he's just got a small fundraise away. I'm pleased to say we need that because we need people breathing life into the small cap sector again, and I think it's starting to happen. So well done to Lawrence. Yeah.
Yeah, well, I interviewed him a couple of weeks back, so if anybody wants to watch that, have a look at it. But I've got another one of these. Used to be his. He worked with him at Gresham, Richard Stavely on Monday. So anybody wants to tune in and ask him questions.
Brilliant! Oh,
that's 9:30 on the Monday morning. Okay, we've got it's the very, very final one. Just to tuck it in for Tony, he's asking about Trustpilot, and the reason he's asking about it is basically they seem to be one of the few winners of the generative AI, because they came out with a statement last couple of weeks ago saying that they're benefiting from a lot of citation from ChatGPT and Gemini, because it seems as though the consumer reviews are being used as a way of authenticating the answers that Gemini and ChatGPT are giving when people ask them, where do I get, a good car? Where do I get an iPhone? That kind of stuff. So
interesting.
I don't know if you've got any take on it at all.
Not really. The only thing I'm a bit worried about was that there's some shorting dossier on them, isn't it? Saying it's
right.
You have to pay fees to basically manage the reviews in your company's favor and so on. But I hadn't seen that announcement about AI. That does sound interesting. Yeah, I mean, I can't get anywhere near to the valuation on Trustpilot. Yeah. So I did have a quick look at it over my Caesar salad today in anticipation of this. And I'm thinking I can't get close to that valuation, so it's not for me.
Yeah, it's a very healthy option, that Caesar salad.
Absolutely.
Yeah, I would say to Toe, if anybody has got any idea about Trustpilot, whether it is paying any of the generative AI to get high on their citation scores, I'd be really interested, or not, as the case may be, because if it is just they're getting used as the de facto standard for consumer review products, then they've got a really good sort of like market at the moment, a really good sort of like marketplace for this whole area. But actually, they could be just sending a few dollars to ChatGPT and to Google to get high up on the citations. I don't know. But if anybody's got an answer to that, I'd be absolutely fascinated to.
Interesting. Follow the money, as they say, don't they? Who's paying whom? And interesting.
Anyway, thanks everyone for your questions. It's been another fascinating session, really jam-packed. And Paul now has got to go and do his interview with Gordon, and then can tuck into his second Caesar salad and pizza probably down the So thanks again, Paul.
Oh, I do enjoy doing these. They're great fun. Thank you to everyone at home as well for interacting. So we'll see you next week. We're doing one next week, aren't we, Paul?
Yeah, same time, same place, same channel. 2:00.
Brilliant. See you then. Bye for now.